You can lose your job in the next economic cycle without a single person in your workplace making that decision. And you can do everything right, play by every rule, and still watch your paycheck get smaller while your rent, food, insurance, and car payments get bigger. That is the part nobody wants to say out loud. The new threat in 2026 is not just inflation or recession, it is power concentrating in the hands of governments and investors who treat ordinary people as adjustable parts, and they can move the parts with one policy shift. This is not financial advice, this is financial education. I am going to show you the mechanism, how politics turns into job loss, how interest rate decisions and global debt turn into quiet suffering, and how markets keep rising while real households sink lower. You will also see why the debate around AI jobs, housing, and retirement is not separate from this. It is all the same system, just different disguises. Right now, in 2026, you are living in a world that feels unstable in every direction. You hear that artificial intelligence is transforming work, but what you really see is fewer entry-level roles, more contract work, and job postings that demand experience you do not have because the bar keeps moving. You hear that inflation came down, but your purchasing power did not magically return to where it was in 2019. Your salary might look fine on paper, but your bank account does not. And every time the market hits another high, it feels like the scoreboard is fake. So here is the uncomfortable question. Why does policy seem to prioritize the winners before it even reaches you? Why do leaders talk like you are the problem when the mechanism is moving you out of the way? We are going to walk through the dark truth in 4 steps, and by the end you will understand why the next few years can feel like a tightening vice rather than a smooth recovery. And I promise you, the story will not end with comfort. First, let us start with the simple political structure people ignore. In the United States, when one party holds enough seats across the Senate and the House, you stop waiting for gridlock. You start dealing with velocity. You stop dealing with debates that take months and years. You deal with policy that can be pushed through faster than most households can prepare. You do not need a conspiracy. You just need enough votes and a clear agenda. When the political majority shifts, it changes what markets are allowed to price in. And markets are not charity. They respond to incentives. They respond to the likelihood of tariffs, immigration restrictions, tax changes, and industrial reshoring. The stock market does not ask whether your job is secure. It asks whether corporate cash flow becomes more favorable under the new rules. Now pattern interrupt. You might be thinking, I do not live in the country you are talking about, so why do I care? If you are in the United Kingdom, Canada, Australia, or parts of Europe, you already feel the spillover. Your economy is not an island. Global supply chains are not optional. Rates set by the Federal Reserve still echo across currencies. And when the United States shifts its trade and industrial policy, other countries feel it through orders, commodity flows, and capital investment. But let me make it more personal. Picture a 32-year-old nurse named David. He works nights in a hospital that is already cutting staff because reimbursements feel unstable. David hears people argue online about presidents and tariffs like it is entertainment. Then a year later, the hospital starts outsourcing more tasks to a vendor because contracts change. The vendor's costs change because the equipment supply chain changes. The equipment becomes more expensive because import rules tighten. The vendor cuts labor. 2 of David's co-workers get laid off. David did not vote for trade policy. He did not lobby for tariffs. He did not write a single bill. Yet his workplace reorganized itself under incentives he never saw coming. That is the first lesson. Policy creates incentives. Incentives create corporate behavior. Corporate behavior creates layoffs. And the average person is always the last to connect the dots. So what is the policy agenda that can accelerate this chain reaction? One version includes 3 big moves that together can raise costs quickly while reshuffling employment. It often starts with restricting certain forms of immigration, especially labor that is used in physically demanding low-margin sectors. It then moves toward reshoring, or at least encouraging production inside the United States, and it often uses tariffs and pressure on trading partners to enforce compliance. You might hear this described as tough bargaining, or national security, or economic patriotism. The financial mechanism is still the same. If labor costs rise and input costs rise, and if companies cannot pass those costs through quickly, margins compress. If margins compress, jobs get cut, or hours get reduced, or roles get automated. Even if the plan says more jobs, the transition can be brutal. Here is where your mind might try to protect you. You might tell yourself that firms will adapt by raising wages to attract local workers. But wages do not rise instantly. Employment law does not bend overnight. Training takes time, and if companies are forced to operate in a higher cost environment immediately, many will simply reduce capacity first. Now, I want you to understand how quickly this can hit everyday life, even if the total story takes years to unfold. When labor that was previously cheaper becomes more expensive, the firm has three choices: raise prices, reduce output, or cut labor. In the real world, firms often do all three at once, so yes, it can drive inflation. Not the political inflation headline you hear on television, but the inflation you feel at the grocery store, the inflation in insurance premiums, the inflation in rent renewals, the inflation in maintenance costs. Because the cost of repairs is also tied to supply chains and labor availability, and if you think you will simply ride out the inflation until it goes back down, let me give you the second layer of the dark truth. Even when inflation declines, the purchasing power loss often does not fully reverse. If your salary did not catch up to the higher prices, you are permanently poorer relative to what you were promised. Pattern interrupt. You have likely heard economists say inflation is transitory. That language is meant to reassure you while policymakers buy time. But for households, the damage is cumulative. Suppose prices rise and your wages lag for multiple years. Even if inflation later falls, the higher baseline remains. Your cost structure has changed. Your life habits have to change or your standards collapse. So the first mechanism is cost pressure from labor and trade shifts. The second mechanism is job relocation and unemployment adjustment disguised as industrial policy. Reshoring and bringing manufacturing back sounds like creating stability. But stability for whom? If a company moves a plant from overseas to the United States, yes, they may hire workers in America. But that is not the whole story. They also often reduce headcount during the move. They often replace parts of the workflow with automation because incentives and technology are aligning. And they also might delay hiring until production ramps up. Meanwhile, overseas regions do not just vanish. The workers in those regions lose jobs and scramble for replacement work. Capital follows policy incentives, but human labor does not relocate as easily. People need housing, schools, healthcare, visas, and community ties. When those do not move with the same speed as factories, unemployment becomes a local shock. Now let us add a third mechanism. Markets react before policies fully materialize. You can see it in how investors position in advance. In the past, when policy expectations shifted, certain industries benefited quickly. In the United States, technology and industrial supply chains can reprice rapidly based on anticipated government action. Sometimes a stock jumps dramatically in days because investors front-run the future. But here is what makes this dangerous for your life. The stock market is not a measure of household security, it is a measure of expected profits for shareholders. If corporate cash flows rise while labor is cut, the market can rally and you can still suffer. And when the market rallies, you hear the wrong message. You hear that things are fine. You hear that the economy is strong. But for millions of workers, the real story is fewer hours, higher bills, and a shrinking safety net. Pattern interrupt again. If you want proof of the disconnect, look at wealth concentration. The top 1% in many developed economies owns more than ever, and it keeps compounding while middle-class households deal with debt and high living costs. According to multiple recent analyses, wealth inequality has continued to rise even as headline growth remains positive. That is not a mystery. It is a transfer mechanism. Asset holders benefit from rising valuations, while wage earners bear the cost of policy adjustments. Now, let me connect this directly to the 2026 reality you cannot ignore. AI disruption of employment. AI does not replace jobs only through robots walking into factories. It replaces jobs through software automation, through scheduling systems, through document processing, through customer support routing, through accounting workflows, and through code generation. The roles that disappear first are often middle-income roles that relied on routine tasks. The roles you hear about as secure careers were often secure only because the workflow stayed manual long enough for wages to catch up. But now AI can do faster and cheaper work than many entry-level teams. That means if your sector is already experiencing cost pressure from immigration restrictions or reshoring incentives, the company also has an extra lever, automation. So you get a double squeeze: higher cost from policy shifts and higher productivity from AI. When leadership hears both, the decision becomes easier: cut labor, invest in systems, and keep the profit line stable. That is why learn to code advice from the early 2020s aged so poorly. In 2026, AI helps you write code, but it also reduces the number of people needed to produce software. Competence is still valuable, but the market is smaller than it used to be. You are not competing only with other humans. You are competing with an interface that can draft solutions instantly. So when you read headlines about leaders promising job creation, remember the real mathematics. If the labor force requirement falls because AI improves productivity, job creation can be delayed or hollow. Meanwhile, the bills do not pause. Now here is where it gets ugly. Even if a government wants to strengthen industry domestically, they still need money. Governments survive on revenues and borrowing, and in the last decade, the global debt problem has become a permanent background radiation. Global debt has exceeded $300 trillion across multiple years and continues to climb. That is not a fun fact. It is the environment that determines how interest rates, budgets, and currency policies play out. So let us talk about interest rates, because this is where your life intersects with the Federal Reserve in a very direct way. When the Fed raises rates, borrowing becomes expensive. That hits households through mortgages, car loans, credit card rates, and refinancing costs. It hits businesses through higher interest expense. It also changes asset valuations because discount rates rise. But here is the dark nuance you may not have understood. Even when the Fed later pauses or cuts rates, the damage is often already done. Many households lock into higher payments. Many businesses restructure and cut costs. And the global financial system keeps repricing. In 2026, people have heard rates stabilized in one form or another. But stabilization does not mean your purchasing power regained what it lost. It means the bleeding slowed, not that the wound closed. Now add the risk from trade policy. Tariffs and restrictions can raise input costs. Higher input costs feed into inflation. Inflation feeds into wage negotiations, insurance premiums, and central bank caution. Governments then face pressure. Do they keep rates high to fight inflation, or do they cut to reduce the cost of servicing debt? You end up with policymakers juggling fire. They often choose what protects the system rather than what protects your budget. And then there is the liquidity problem. Governments need cash buffers to run. If policy shifts require subsidies, tax changes, and industrial investments, governments need available funds. If debt servicing costs rise, they need more cash flow. That often pushes them toward expansionary measures or at least toward financial engineering. You can dislike this next sentence, but it is the truth. Money creation can be used to handle debt pressures. When debt is huge, leaders do not always have clean choices. Now I want to return to the political agenda with one more brutal point: tax changes and the incentives they create. When political leaders talk about reducing corporate taxes or offering incentives to bring investment home, the public often imagines that wealth trickles down quickly to workers. That is the fairy tale version. The darker version is that companies respond by optimizing tax behavior and shifting assets. When tax rules become complex, large firms can restructure ownership across subsidiaries and jurisdictions. They do it with spreadsheets and lawyers, while you do it with your paycheck. You can hear this debate as fairness, but the market sees it as after-tax profit potential. That profit potential attracts capital. It also encourages consolidation, and consolidation often means fewer jobs or fewer distinct companies competing for labor. So you can get a world where corporate profits recover while job security erodes. That is not an accident. It is the result of incentive design plus political majority plus speed. Now let us connect this to housing, because if you are watching this, housing is probably already crushing you. Housing affordability does not recover like a stock index. When housing prices detach from wages, a generation can slide into permanent renting. Their wealth is not growing because their biggest expense is not an investment, it is rent. And rent is a form of forced contribution to landlords and investors, many of whom own multiple properties. So how does policy aimed at reshoring and trade fit into housing? When households face higher costs and job insecurity, they delay buying homes. When mortgage rates have been higher for longer, home affordability collapses. When governments prioritize industry subsidies and tax policies rather than direct housing supply, the shortage persists. Meanwhile, wealthy investors can use credit and cash holdings to buy more assets. That means housing can become a wealth transfer machine rather than a stable life foundation. In 2026, this is especially painful because climate-driven disruptions are raising insurance costs in many regions. When insurance markets collapse or premiums spike, housing becomes even less stable. People do not just fear floods or fires, they fear the next renewal notice. So tell me, how does a person build savings when rent rises, insurance rises, groceries rise, and their paycheck is threatened by AI and policy shifts? You cannot budget your way out of structural changes. And here comes the retention point. When you cannot save, you become credit dependent. Credit becomes expensive when rates rise. When rates fall, the structure does not magically repair. It just shifts into a different form. Debt becomes the bridge that keeps you employed, until it does not. Now pattern interrupt for the third time, because the next part is where denial ends. Crypto promised freedom from banks. People were told it was decentralized, resistant to control, and a hedge against institutions. But in 2026, regulation tightened and institutional capital moved in like water into a crack. Many of the biggest crypto holdings are controlled by large entities. Retail investors are often the liquidity providers, buying into hype and selling into panic. You might ask why this matters in a script about jobs and trade policy. It matters because when wages are squeezed and savings evaporate, people look for alternatives. They chase passive income dreams. They buy into platforms that promise easy returns. They forget that freedom is still subject to market cycles, regulatory risk, and custody risk. And when the next downturn comes, crypto can crash as hard as anything. Then the vulnerable investors discover that volatility is not freedom. It is a trap. Now, remember that we started with the idea that job loss can happen quickly because the entire country can decide to make some types of companies less viable. This is where the story becomes truly ugly. It is not only about immigration or tariffs, it is also about industrial selection and pressure. When a government pressures supply chains, it can force companies to change locations and vendors. If you are a vendor in one region, suddenly your contracts become conditional. If you are a manufacturer, suddenly your inputs are delayed or more expensive. If you are a logistics firm, suddenly routes change and costs rise. In the private world, businesses respond by making headcount decisions, not because they hate workers, but because they must protect cash flow, and cash flow is the king. Let me explain cash flow with an example you can picture. Suppose you own a house worth $10 million. You have a mortgage balance of $5 million. On paper, you are fine. Your assets are bigger than your debt, but if you cannot pay the monthly mortgage payment, the bank does not care about your net worth. It cares about your liquidity. It will force a sale. It will get its money back, likely at a discount. Governments are the same in this way. They can have assets, they can have future tax potential, but in the moment they still need liquidity. In a high-debt environment, liquidity becomes tighter. Interest rates, bond demand, and currency confidence all become part of whether governments can operate without